Hello and a very warm welcome to everyone from CRED. We are very excited to bring to you a series of finance webinars every Saturday, starting today, featuring an expert and thought leader in the space of finance, taxation, investments, and all things money. In today's session, we have with us financial wellness expert and the founder of the Money Hansi Mehrotra, who is here to share her insights on budgeting, personal finance, financial planning, and more to help you ensure your financial wellness. With a 20-year-long career in wealth management, Hansi is the visiting faculty at the prestigious Wharton University and has been named as the top voice and a power profile by LinkedIn several times for her very impactful blog. Post your burning questions on personal finance today and in the chat box and learn how to make the right financial decisions from today's session. We'll get Hansi to answer those questions towards the end of the session, so stay tuned and make the most of it. The video will be available right after the stream ends on this YouTube channel. For more sessions and informative videos like these, subscribe to our channel and stay updated. Hansi, a very warm welcome and over to you.
Get started. So like I said, I can't see the speaker, so I can't hear the speakers and I can't see the chat. So I'm hoping everything is visible now. So basically, like I said, the money hunt. So I got out of suit today. I put on a semi sort of formal thing, but my motto is what is now called globally the FIRE movement, which is financial independence, retire early. The FIRE movement globally was actually motivated by a book that I also happened to read, gosh, nearly 25 years ago, and maybe even longer. And that's what I've done. So today's topic is financial wellness. But before we get to financial wellness, I am influenced, and I've thought about this deeply, about what is happiness. I know this sounds very philosophical, but in the end, we are going to talk about money. But what is money for? So like I said, I thought about this very deeply for quite a few years, and I realized that I want to be happy, and then let me maximize sort of all the things that make me happy. And this is what I found. There are basically three things that most people say makes them happy. There is health, good health, which we take for granted. And I say health in terms of not just physical, but also mental. It's something that, again, I have had experience sort of firsthand. So it's something that you shouldn't take for granted. So put health above everything else. Second is relationships. Deep relationships with family and friends is what you should put ahead of money and work. Definitely maximize for that. And the third thing is work, meaningful work. And something that I've come to appreciate more recently is control over your own time. What does that mean? That means success is defined by being able to do what you want to do, when you want to do, with whom you want to do, for however long you want to do it. Okay, if someone else has control over your time, that's. I mean, some people love it, and that's each to their own. But I've sort of realized that the more people have control over their time, the happier they are. So that's the context in which I'm saying everything else after this. So now let's get to wellness. What is wellness? So I call myself a financial coach because I kind of compare myself to, in the normal health wellness, I compare myself to a trainer. So if you are young and healthy, the only thing that you need to know is how your body works, how nutrition works, and therefore how much exercise to do, right? Nutrition and exercise. That's what a nutritionist and a trainer can help you with. So what I'm doing today is the equivalent of that. It's basically education. Once you reach a certain age, it could be 40 odd or so, that's when you perhaps go and start seeing a GP for checks, for preventative checks, or of course, if you have a problem. So either at a certain age or when you have a problem. And then if you do have a problem, then they refer you to a surgeon, right? So that's the equivalent of, the GP is the equivalent of a financial advisor. and the surgeon is the equivalent of an investment specialist, a fund manager, a PMS manager, or someone like that. So what I'm doing today is basically the very basic sort of things that you don't need to go and see a financial advisor for. But by all means, if your situation is complicated or you're very wealthy, then you should see a financial advisor. In fact, a financial advisor will find you. So you don't even have to go looking for them. But anyway, so what I'm doing today is basically that. Now, that should be enough to live a well, healthy life, right? That's what we're saying. Now, what is financial wellness and how is that different from normal wellness? Obviously, wellness is health related. So this is a Mercer sort of definition. By the way, I used to work for Mercer, so these are my ex-colleagues. They have put out 4 criteria of defining wellness, financial wellness. One is control over your day-to-day finances. Okay, so being able to do budgeting and having control over it. Second is the capacity to absorb a financial shock. So should something happen, you're able to get out of it. Third is having the financial freedom to make choices. And fourth is to be on track to meet your financial goals. So that's the official definition, and that's what we're trying to do. I think the order in which they do it is not quite right. And also, you see all the goals that they've put up on the chart is what a typical financial advisor will tell you, that you basically have all these goals and you should be able to meet all of them, and that's what makes you financially successful. I think the key to doing or being financially well is, one, define these goals. And having so many, I think, is just too many to keep track of. So the thing that I recommend, so secret number 1, so we're talking about secrets today, right? So secret number 1, financial wellness obviously depends on how you define these goals. I believe you could group these goals into 3 different levels. By the way, 3 is my favorite number, and you'll see this coming up right through the next sort of half hour. So take all your goals, whatever they are, whether it's buying a house or travel or kids' education or your own education or wedding or retirement or jet, okay, if you want to own a jet for that matter. So whatever it is, group them into 3 manageable levels. The 3 levels, the first one is the certainty to have a basic lifestyle. So what we in India call the roti kapda makan. Okay, so you have to have roof over your head, you have to have some basic clothes, and you have to be able to eat dal chawal. That's my definition. Now, obviously, a Mukesh Ambani's level of basic lifestyle is going to be very different to mine. Totally understand. So you have to decide, and only you can decide what that basic level is. The second level is a reasonable probability to have a decent lifestyle. Again, this is different for everybody. In my case, most people that I know define decent by probably their peak earnings. So right throughout the career, if they have hit their peak at some point, and the lifestyle they got used to at that point is what they want to have. And the third is the chance to get rich. To get rich, again, is a relative thing. What people mean by that is the chance to jump from one strata of society to another, maybe 1 or 2 stratas above, if you believe in stratas. In my case, it might be, I mean, I like traveling, but maybe staying in a nicer hotel rather than in the hotels that I normally stay. So that would be the 3 levels. Notice the way I defined it: certainty, reasonable probability, and chance. These terms are very, very key to how you invest, which we'll come to later. At this point, just notice the words that obviously the lower your goals, the more certain they can be. The higher your goals, the less certain they are, or the more uncertain they are. All you have to do is just basically group them into these 3. So that's tip number 1. So now let's get to secret number 2. The secret number 2 is this: that financial wellness is not about numbers. So let me tell you my experiences. When I go to events, parties, whatever, usually, you know how conversation starts, right? It's like, okay, what do you What's your name? Which is the first question. And within 10 seconds, it turns to, so what do you do? Invariably, people ask me, what do you do? And I say, I work in finance. I kid you not, the number of faces I get, most women tend to jump directly to, oh, you must be good at math. I'm not good with numbers. My husband over there is an investment banker. Can you go and speak to him? The men I meet kind of say, oh, okay, so you know something about the market. So what do you think of the market right now? Are we at bubble territory? What do you think of Bitcoin? What do you think of SPACs? What do you think of whatever? And they start showing whatever the latest thing that's happening in the market. That's what usually happens. And like I said, people's perception about finance being about numbers is very, very strong. To me, what we said in the last chart, which is basically the probability, is the most difficult concept. Everything else is like level class 6 math, maybe, not even class 6, maybe even younger. So addition, subtraction, multiplication, maybe division, okay? That's about it. So you do not need to know any math. In fact, I haven't studied any math since year 8, because I jumped 2 years and then went into arts and all kinds of things. The point is, you do not need to know math. Probability is the hardest concept. And again, what we deal with day to day is enough to manage our finances. So what, if not numbers, what do you need? So here's the secret. Investing and financial wellness is less to do with numbers, more to do with how you manage your emotions. And that's obviously something only you can control. What do I mean by that? Greed and fear being among many emotions that you will need to master. So I've just sort of put up some points that you will need to know. One is that you are a function of your own personal history. So definitely what generation you are. So if you were born in the 70s like me, you've had a different experience. We've only seen the markets go up. We've only seen interest rates come down. So that experience is very different from what our parents had. And that is very different from what our grandparents had. That's very different from, again, in Australia, we've not had a recession for 30 years. So our experience there is very different to what people in India have or what people in the US have. So be very careful about what people tell you based on their experience, because that is not the same as your experience. And that's okay. So one is the generation and two is your specific situation. Okay. So again, my specific situation is that my parents were well off, did make a lot of money and then lost it all. So I've had experiences of living very well and living not so well. So how I function today is a function of that. Similarly, you are a product of your personal history. You have to dig deep into your own history and say, okay, what do you believe based on what you saw growing up and what has happened to you, how you've reacted, what is happening around you. All of that is all personal to you, and you obviously know yourself. So any advisor who doesn't get to know you is not going to understand that. They will give you advice based on whatever they are trying to sell to you. 2, any spreadsheets, especially what financial advisors or robo-advisors give you. So like I said, this whole perception that finance is all about numbers. Interestingly, when you ask them, okay, how did you arrive at this number? It's all based on history. So they say, this is based on this assumption of this return. Where did that number come from? Or it came on the last 10 years, 20 years, 30 years, whatever it is, they base it on history. To be fair to them, if you don't base it on history, what will you base it on? Obviously, there's nothing else, so they want to base it on history. But here's the thing, if you are a student of history, you will know that history is full of surprises. At any given point, any crash that happened or anything major that happened was a surprise. So I'm surprised that people don't learn from that. If it was a surprise back then, what makes you think that what will happen in the future is something that we have already seen? So I remember the exact moment what I was doing when the two airplanes flew into the World Trade Center, 9/11, right? I remember when the 2001 boom and bust, I was getting married that year. So I remember what feelings we had when the stocks we bought went up and then when they crashed and then losing everything. So what I'm saying is what will happen is you don't know that, but neither do the experts. So any spreadsheets, any advice they give you that is based on history is take it with a pinch of salt, take it with a grain of salt, bucket loads of salt. So history as a map of the future is a problem. So make sure that you leave a big margin for error. The one thing that hasn't changed and will not change definitely in our lifetime is how we react, how we humans think, our greed and fear. And so this is why I'm saying this. I see so many people, so many advisors give you a questionnaire. 6 questions, 10 questions, 15, 25 questions, depending on how simple they want to make it. Here, fill these answers, answer these questions, and this is your risk profile. The risk profile is an odd thing. Every regulator in the world says you must have it. I have never seen it defined in terms of one number or one sort of psychometric thing. There are people who say that your psychometric profile doesn't change over time. Possible. But I also think that you can be fearful and greedy at different times. Not only that, but you can be fearful and greedy at the same time. And my worldview and the way I give advice is based on that. For parts of my portfolio, I am very fearful, and parts of my portfolio, I am greedy. I want to make more money. And I think people around me are pretty much the same. So be very wary of these risk profile questionnaires. Secret number 3, you can achieve financial wellness with simple mental models or back of the envelope calculations. This is exactly what I'm doing on this website. This is themoneyhunts.com and what I'm doing right now. So, okay, let me give you some mental models. In fact, I've already given you one. So when I said, think about your goals into 3 different levels, that's already a mental model. What is a mental model? Mental model is basically a framework on how to think about things. So rather than having a piece of information, someone impressive even, sort of telling you something and you try to remember that fact, rather than doing that, you basically form an understanding of how that whole thing works in totality. Once you do that, then all the bits of information that you get will make sense. So let me give you some other rules of thumb or back of the envelope calculations. And these are meant to be just that. I'm saying that it's enough to get started. Remember, as a coach, by all means, you can go and dig deeper at the GP and the surgeon level, but to get financial wellness, back of the envelope are enough. So for example, this is the navigation menus of some very popular websites, personal finance websites. See how they give you information in terms of throwing things at you. And then versus what I've put on the right-hand side, which is basically a simple, okay, what is personal finance? Okay, you earn money, which you have to do first. And then you simply either you spend and save, you protect, or you grow. There are only 3 things you can do with it. And grow is basically you either grow growth assets or income assets. Protect is protecting the downside. So what I'm saying is, see if you can understand everything that is being said with a model, and then, and if you don't understand, put it back on the speaker to let them explain it to you, because individual facts just by themselves mean nothing. So here's some screenshots from my site. Let me actually sort of show you. Can I? Yeah, okay, there you go. So this is from themoneyhunts.com. And if you click on plan, okay, so what I've said here, that a financial plan is as simple as 3 steps. 1 is think about the past. Where have you come from? 2, what the present, and the third is the future. As simple as that. Oops, sorry. Now I can't navigate. There you go. So, oops, sorry about that. So that's basically the three financial plan. Within that, when I said past, where have you come from? Like I said, money beliefs is already something that I've said. The outcome of digging into your past is one of the outcomes that you could then do after you state your money beliefs is do your net worth calculation. And I've got a little calculator on the site itself. I call it the Money House, and I'll talk about that in a second, to figure out basically a simple Excel thing that you take, list all your assets and all your liabilities, and one minus the other is your net worth. Okay, net worth, whatever you want to call it. Not your self-worth, but net worth. Okay, so that's the simple thing. The second thing is, where are you now? So where are you now is two things. How much are you earning? And by that, I mean not just the gross number, the CTC number, but also what is your hourly rate? Not just net of tax, but also adjusted for the time, the effort it takes for you to earn the money. And again, I've got a little calculator on the side. And I've also got a little calculator for the next step, which is budgeting. So where you now is about how much are you earning and where does the cash go? They're the two questions you're asking. And the third one, which is basically where do you want to go, which is basically your goals. So I have got 4 calculators on the site right now. Slight tweaking is still required, but they're there right now to help you do that. So, for example, in the budgeting thing that I put up is some simple rules of thumb in terms of what people spend on, again, 3 sort of buckets, which is needs, wants, desires. Needs should be no more than 50%, wants should be no more than another 20%, and savings should be basically 30%. Now, people ask me what's a good budgeting tool. So given that we're talking to Cred, I just thought I'll mention it that I have used credit cards as a budgeting tool. I have used it all my life for 25 years now. I've had a credit card, actually more than that. But anyway, I've had a credit card, and what I do is simply put all my needs, so utilities, groceries, basic rent, or EMIs, whatever, on direct debit from my savings account or on a debit card. So basically, all need to have go directly from my bank account. Everything else, so eating out, drinking out, buying clothes, travel, everything else, I put on my credit card. And I ensure that the credit card gets paid off on the last possible day that it needs to be paid off. So I'm using the free credit that credit card companies give to the max. And in the meantime, my money is still sitting, depending on when I had it. When I had a mortgage, it was sitting in the mortgage account as an offset to maximize what I was paying off that month. And I was using the credit card to basically live my life and pay it on the last possible day. In fact, I've also used my credit card to buy this house, which I'll discuss later. But what I'm saying is they're useful things. They're useful things, and therefore you should always have one and maintain one and definitely get a good credit score. Now, the other thing that I mentioned, which is the money house. Now, what I do here is, let me just jump directly to the site because that is a better picture. So this is the site, okay, themoneyhunts.com. And if you click on plan, they are the tools that I was telling you about. They're right here. But if you go under learn about the money house. Now this is basically the house that, so it looks simple. Like everything else that I'm sharing today, it looks simple, but trust me when I say I've taken all the investing experience and the behavioral finance experience and combined it. So remember when I said you need to have 3 levels of goals: needs, so certainty, reasonable chance of getting market return or good return, and then the chance of getting rich. So the way you can think about your wealth is the same way. So building wealth is like building a house. One, you need to understand yourself, which is the architect. So you are the architect, so you need to understand the lay of the land, which is the economic environment, and yourself. Then you put a foundation down. The foundation is basically, hang on, sorry, I didn't realize I'm not sharing screen. Okay, so this is the website, sorry about that. So this is the money house, which is basically underlearn. So what I'm saying is that you are basically putting some part of your money as a foundation. This is money that you almost hide from everybody else. The foundation goes under the ground. Similarly, this is money that you want to hide from everybody else because this is what is extremely important to you and you cannot afford to lose it. So what goes into this is cash, emergency cash. It could be 6 months, 12 months. I've got 2 years worth of cash, okay? Just in a savings account or in a liquid fund or both. In fact, both and multiple countries. Your personal house. Now we can discuss whether you should buy or rent, and that's another sort of discussion. But for some people, having a roof over your head is very important. For me, it as well. So your house goes into that. Your insurance goes into that because your most important asset is your ability to earn an income. So you need to have health insurance. You need to have life insurance if you have dependents. And you need to have income protection, which unfortunately in India, they don't sell. So they're the three things that ideally you should have in the foundation. Now understand that if you hide everything in FDs and savings account and gold and house, then your money will never grow and you will never keep up with inflation. So then you build two pillars. One, the first pillar is your own skills. Keep reinvesting in your skills so that you can earn more and more money. And the second pillar is a growth portfolio. In my case, if it is only for my retirement or kids' education, which is years, decades away, I've put all my money into equities, fully invested in equities, and it's just running and I don't check. It's in the pension environment, not in India. So therefore, I can't get my money out. And that's good because I don't bother checking. It's not on an app. I basically get the statement sent to me once or twice a year, and that usually comes months later, so I don't even look at it. So it just keeps running. The third is the freedom slab. So this is basically when you are close to meeting your goals, which could be retirement or your kids' education or whatever it is, you convert part of your assets into passive income or into an income stream. So you convert growth assets to an income asset when you need the money. Until then, just invest in growth. So this is only relevant for people who are actually now in the using money from or income from their investments. And the fourth thing is the fund money roof. This is money that you want to invest for fun or use for your hobbies or start a business or get those ESOPs or buy that piece of land. Basically, high risk, high return. It's high risk, high return, which means that the chances of it paying off is low. If it pays off, you get into next strata of society. But if it doesn't pay off, the rest of the house is still standing, which means the rest of you're unbreakable. You are able to recover from a setback. I wish my family had done this. Okay, I wish my dad had done this and he wasn't able to recover, but I definitely am methodical about hiding some money, making sure my growth portfolio is there, and now having fun with all the business initiatives that I do. So I have those mental things. This is how I manage my own money. And I don't know of anyone, including Harry Markowitz, who invented the efficient frontier, the numbers I was telling you, how robo-advisors or any advisor gives you this efficient frontier, optimal portfolio. Anytime they use these words, they are actually referring to a concept by Harry Markowitz. Even he, when asked, how do you invest your own money, did say 50-50 in equity and bonds. Now, he did adjust it later. And when asked about that, he did say, people are not spreadsheets. We are humans, okay? So if that's how he invests, which is basically in a reasonable way with, in fact, even Warren Buffett's methodology is much more back of the envelope type rather than major spreadsheets. So this is how I invest, and this is what I'm saying about don't be caught up by sort of efficient things or so-called efficient things. Fourth secret, and I'm going to rush a little bit now. Fourth secret is habits are better than goals. So after talking the last 15, 20 minutes about how financial wellness is about meeting your goals or being able to meet your goals, I've told you now how to meet your goals. Now I'm saying, yeah, goals are passé. Okay, so actually, what is better is habits. Now, what do I mean by that? It's like normal health wellness. Okay, it's, you know how when you say I want to lose X kilos of weight, um, it's you're not happy until you lose that, and then usually invariably you put that back on, because once you achieve that goal, you then kind of stop doing whatever it is that got you there. It's similar to that in wealth. It's better if you drink plenty of water, exercise every day, and just make it a habit to live well, right? Same thing with financial wellness. If you basic habit, if you spend less than what you earn, simple, right? But amazing how people don't do it. If you basically spend less than what you earn, which means you save the rest, invest it, and invest it in simple investments, and I'll talk about that in a second. That is more powerful than someone giving you the latest tip about what some investment will do and somehow make you rich. Also, and this is something more recently I've heard a guy on Twitter say this, and Naval Ravikant said this. Goals are like, I think he said this, actually somebody else might have said it, sorry. He said goals are like a contract you make with yourself, that you're unhappy until you achieve your goal. I quite like the way that sounds. So I've kind of given up on goals. I now live my life every single day as, what can I do today to be happy? Have good habits and be happy every single day, as opposed to, oh, when I have this house, or when I have that vacation, or when I have that, I will be happy. That's not a good way to live at all. So same thing with investing. Secret number 5. So investing can be automated to get the benefits of free lunches. But the only 2 free lunches that I know of is in investing is 2 things: diversification and compounding. Diversification is basically diversify. So spread your eggs in multiple baskets. So your investing needs to be diversified, especially in the blue growth pillar. Okay, your concentrated bet, we'll talk about it in the fund roof, but basically diversify. And compounding is, I know people keep saying it's the 8th wonder of the world, but it's simple math. It's basically interest on interest. For that to work, however, is you need to let it run. You need to have a portfolio that you let the returns not be taken out, but reinvested, and keep getting reinvested every single month, year, decade. If you do that and do not touch the portfolio unnecessarily, you will get a decent outcome. And obviously, it depends on the levels, but that's the simplest way to actually ensure that you get a good, long outcome. And here's the thing. These things you can get with simple market returns. What do I mean by that? It's the market does most of the work. So if I'm a long-term optimist, I believe that India GDP or the world GDP will keep growing and the world is not coming to an end, and I can invest in financial markets as a proxy of growth being around for the next few decades. I'm saying that I believe in human ingenuity to keep sort of inventing a good future. If I do that, I should invest in equities and let it run. Remember, I said my retirement portfolio I've not touched in a decade, and I can keep adding to it and not touch it. But I have enough cash lying in my foundation to be able to meet any financial shocks that is thrown my way in the meantime. So if I do that, a market index sort of return is more than enough. So anyone who says that, oh, in India you can pick mutual funds because there's active alpha, misses the point. And again, I've done mutual fund research for 25 odd years. Let me tell you this, mutual fund selection is not as simple as it looks. Okay, I'm right now working with a bunch of interns who are doing their CFA, and they're only just starting to appreciate this. It is not a matter of simply looking at the best performing fund. There's no such thing. Either they performed well in the past, and that there's a reason why every regulator says there's that past performance is no guide to future performance, and you cannot predict it. Okay, anyone who says that they can pick a fund that will outperform in the future, ask them what certainty. Will they guarantee it? Of course they won't. So you lose so much time and energy trying to select stocks or funds and then having to change it every few years because the fund manager left or the AMC got acquired or there's something or the other, markets crashed or the riskometer wasn't right. I don't want to say scams happen because mutual funds are by and large very safe vehicles, so I don't want to scare you on that. But what I'm saying is it's still not worthwhile to try and get that active alpha of 1 or 2% when the market is most likely to give you sort of 10 to 15%, somewhere in that range, because it usually tracks the GDP. So that's the simplest way to get started and build a portfolio. You don't need to go and do anything more than that. And the last secret is basically to get really rich. That's where you need to focus on the fun roof, which is basically you cannot get rich with ETFs or mutual funds for that matter. Okay, so if you are listening to me because you want to get rich, you're in the wrong seminar anyway. But if you still want to, in addition to having financial wellness, you also want to get rich, then the only way to do that is figure out what you're good at. Okay, so focus on a high conviction idea, whether it's your own business or whether it's like I said, a stock or a piece of land or you've built your own app or you're a music performer or whatever. Okay, something that you are very good at and you have very high conviction. Once you have that, you need to leverage it. And by leverage, in the olden days, leverage came from putting factories, labor and capital. In today's world, you can do that with media and technology. And the old-fashioned, like labor, the capital meaning borrowing. Okay, so you need to have one or multiple of these leverage factors. So either borrowing capital or reaching millions of people or technology. Well, technology and media, basically the same thing. They're trying to reach multiple people. Okay, so that's how you get really rich. But you can't apply leverage if you do not have the first bit, which is basically something that you have very, very, very high conviction on. Okay, that's a definitely a must. And now to some non-secrets, and let me just wrap up so that I have time for questioning. In case people have any questions about millennials and whether they should take loans and loans for any other things, we can talk about that. And also women is an area that I work with quite a bit, partly because I keep seeing, remember I said in parties when women say, you must be good at math and I'm not confident. What they're really saying is not that they don't know. They actually know as much as the men. The issue that I think is confidence and or something else that is happening, which is basically they don't have the bandwidth for it. And it's something that I'm exploring in a new podcast that hopefully I will put live next week, fingers crossed, and we will discuss that. And on that note, I will wrap up so that we have time for questions. I'm on all social media as The Money Hunts. So Facebook, Instagram, YouTube, LinkedIn, Twitter, Clubhouse. No, Clubhouse, I'm under my own name. Everywhere else, I'm as The Money Hunts. So now I will stop sharing my screen and I look forward to questions. Ankita.
Hey, Hansi, thank you so much. Just to avoid
Again,
any
I
audio
think
lag.
I have disabled the speaker. Let me just... Okay, well, I still can't hear anything, so...
Can you hear me now, Hansi?
I knew this was going to happen. So when I earlier disabled the speaker, now I can't hear anything. Um, guys, can you put the questions into...
Questions? I can't hear anything. Okay, sorry about that. I still can't hear anything, so I'm just going to read the questions. Let me see. Okay, I'm going to work backwards. So please suggest some practical books and authors on personal finance. There's a lot in the market, but many are just colorful titles. So if you can really suggest on that. Okay, so the one book that is hot right now that I would recommend to everyone is The Psychology of Money by Morgan Housel. Morgan Housel is a brilliant writer. He used to write for the Motley Fool, and I've met him in Montreal when I was speaking with CFA. He's definitely brilliant. So please go and read that. A lot of what I said today will resonate. He has said the same thing, but in a much better way, that he's actually put examples in with stories, which means that today you might not believe me, but when you read his books, you will believe me. Okay, Achint Verma. Mutual funds stocks are all talk about long-term horizon and patience. What is the next best investment one can make other than real estate? Okay, everything. So I'm not sure what you're asking. So you're saying mutual funds and stocks are too long, and therefore you want to invest in real estate because it's shorter time horizon. Is that what you're asking? I'm a little bit confused, but basically, okay, let me get this one thing about investments, of any kind of investments, okay? There is no such thing as a bad asset. Everything has a price for it. And if you pay the right price, you should get a decent return. Now, what do I mean by that? Everything has a kind of like you assume normal valuation. Long term, for example, when you buy a stock, you're basically buying a share in a business. The business, if it does well over the long term, you will get dividends. I know dividends paying is not fashionable because of tax reasons, but the point is that somebody somewhere down the track will get dividends. That's where the valuation of the business comes from. So long term, if you intend to hold it for 10, 20, 30 years, you shouldn't worry that much about fluctuations in valuations. You could just jump in. It's only when you have a shorter time horizon is when you should be worried about, is the market too expensive right now? Because if I'm going to retire in 1 or 2, 3 years time, then obviously that's a risky thing. Same thing happens with real estate. So when people say, should I buy or rent? Is this a good investment? Is real estate a good investment? Real estate in itself is not a good or bad investment. It depends on what price you paid for it, and therefore what the rental income is going to be. The increase in valuation is a function of rental income. At some point, the real estate has to be able to be rented out. Otherwise, there is no valuation. Okay, so if you're clear on that fundamental insight, it's okay if the increase comes via increases in valuation. Now the question is, what is that assumption, and therefore what you're paying for it? I believe that real estate valuation if you look at the rental yield and you compare that with your borrowing cost. So if the rental yield is only 2% and borrowing cost was 10%, then that should be a signal to you that things are expensive, and that's not a good idea. But if rental yield is 5% and borrowing cost is also 5%, then yeah, it should be perfectly fine to buy. So I would say any other investment, and they're only, by the way, so there is a video, there's a whole bunch of videos on my channel. There is a video on what is an asset class. Take a look at it, because there's only 2 ways you can invest. There's only debt and there's equity in financial assets. And then there's commodities and there's real estate. So these 4 are the main asset classes. Everything else is a derivative of that, which means that financial professionals like me are dividing it up based on time horizon, on risk, on geography, on a sector, on segment, on style, whatever. Okay, we are making it complicated for you. Actually, we're talking in jargon amongst ourselves because we can go finer and finer detail. But when we talk to you, we should be able to group them and say, okay, by and large, this is equities and this is debt. For example, the debate right now about perpetual bonds, is it equity, is it debt? People ask me about real estate, is it equity, is it debt? So these are things that someone else should be able to explain it to you, but everything is a good investment if you buy it at the right price. What is the best investment instrument for liquid cash that I may need back in the near future? Liquid cash, best is a function of what tax bracket you're in, which country you're in, and all that sort of stuff. So I put my money into some into savings, some into FDs, some into a liquid mutual fund. I haven't ventured into arbitrage funds as much as people tell me that I should. I just don't think that's a good investment for liquid cash for when I need it. I also have gold and I also have some cash at home. How much for a rainy day should one create for himself? Is there any specific ratio? How much for a rainy day? No, there is no specific ratio. Some people say 6 months worth of expenses. I have 12 months. I actually have more than 12 months. So I actually, this is before COVID. Okay. So it really depends on, everything else. Okay. So if you are, for example, a government employee where your job is relatively safe, then you don't need to, I think, why am I wearing this again? I realize.
Anyway, so if I, actually no, sorry. I realized it is on mic. Sorry about that. So if you are a government employee, then your salary is safe and therefore you need less. If you are, on the other hand, an artist, a painter, or someone that has highly variable income, your number is going to be different. So it really depends on what else you have in terms of income source and other assets. So 6 to 12 months, I would say, is minimum. I would say go even more. Okay, other questions at the bottom. If you're saying a mutual fund investing is not making us rich, then how to grow money? I thought I answered it. Mutual fund investment will make you comfortable, okay? So this whole seminar was about financial wellness, and financial wellness, like I said, is grouping into those goals, making sure your foundation is there, your long-term growth pillar is invested in equity mutual funds, okay, in index ETFs ideally. That is going to get you financially comfortable. What I said was you won't get rich, rich meaning in terms of jumping strata of society. For that, you need to take risk. That's what I meant by the yellow roof, which means you have to have an idea, a skill, something, and leverage that. That's what's going to make you rich relative to where you are today. Hope that is clear. Shubhang, which will be the best ETF? Okay, so there's no such thing as best. Okay, I know this is a great Google search term to search for best things, but in investing, there's no one best thing. It's usually a combination, a portfolio of things. So a portfolio of ETFs is what you want to build. If you're sitting in India, you want to start with probably the most liquid, the biggest stocks, which is the Nifty 50 ETF, right? Gives you the exposure to the largest companies. But then you add mid and small cap. Then you add the US companies because they have NASDAQ and US, maybe S&P 500. Then you add Asian companies. Then you add other things. So what I'm saying is you need to build a portfolio. There's no one. Now some straight away jump to, you say ETFs, but ETFs are not liquid and all that drama. We have done this for most retail investors. ETFs are perfectly fine. If you happen to be a big investor and you think you are not getting the right price, get your advisor to check the INAV, okay? And they will know what that means. But certainly any decent advisor will be able to guide you in case there are market discrepancies, okay? And that only is relevant for large investors. For small investors like you and me, you can just jump in and buy without having to worry about any of these things. because you're investing for the long term anyway. Can you talk about the psychology of money at a high level, how to think about it? That's what I was doing, I thought, which is basically that, okay, so the simplest thing that Morgan Housel also says in his book, and I'm saying this now, is you need to come to terms with what is enough for you. There will always be someone who will make more money than you, who's getting richer than you, who has more things than you, who's smarter than you, who looks better than you, who has more followers than you. Okay, at any point, that will happen. You have to decide what makes you happy. Same thing with financial wellness. You have to decide how much is enough for you. I made that call 10 years ago. I was at the peak of my career. I could get another job anytime I want. I can earn money. But I choose to say, if I'm going to spend all my time earning that money and not having time to do what I like doing, which is enjoying this house, reading a book, listening to music, traveling, spending time with friends and family. This is what I enjoy doing. If I have enough money for that, why do I want to go and spend all my time trade off in going and earning a job or investing for that matter? So even though I'm trained in mutual fund selection, I don't select it because I think I have better things to do with my life than going and doing mutual fund selection. So that's what I'm saying about you need to define for yourself what is enough for you. How do you invest in Nifty 50? Okay, that's another small video, but basically Google it. You can go to Zerodha app or any other app and literally search for Nifty 50 and buy it. How can I check whether my mutual funds choice is correct? Not after a year. Like, do I need to continue or change? Do I take advice from some mutual fund advisor? Yes, the short answer is yes. You cannot. See, I think mutual funds, you need to understand, active mutual funds are trying to outperform the market. Okay, it's called alpha. To do that, they have to hold stocks that are different from the index, which means they have to make a call. Sometimes their call will be right, sometimes their call will be wrong. In a portfolio of 50 stocks, if they get 60, 70% right, that's good enough. If they get 20, 30% wrong, that's good enough. So at any given point, however, they will also underperform because by making a stock selection, they've chosen to say, okay, so mutual fund selection is about having conviction that markets behave in a certain way and they will be mispricing and how they will take advantage of that mispricing. So they have to say, okay, right now, Tesla is overpriced and I will not buy it or I will short sell it. XYZ is underpriced, I will buy it because nobody else sees the value. But at some point, they also think that markets will revert to the mean, okay? And that's when they will unlock the bet they've made. The problem is, therefore, at any given point, mutual funds will be seen to be underperforming. So if they're underperforming in the short term, that could well be okay. So it's very hard to therefore check whether your mutual fund selection is correct in the short term. Having said that, yes, you should ask your financial advisor to give you a research note, okay? Not just a fact sheet. A fact sheet states facts. What you want is ask your advisor for what analysis, what research they have done on the fund to select that fund. Have they studied the philosophy? Have they met with the fund manager? Have they decided that fund manager is better than every other fund manager? What proof do they have? Does it make sense? All of these things is what a trained CFA person can do. And your advisor either should be able to do themselves or buy it from someone who is able to. So if you as an investor don't ask for it, financial advisors will not give it on their own. You need to demand it. That's what you pay your commission for or your fee for. So you should demand it, and only then will they start giving it to you, and only then can you understand it. And if you don't understand what's written on it, come and show it to me. Get me on any social media, send it to me, and I will decipher it for you so that people start doing more of this. Okay, how can I invest money in startups at pre-seed level in personal capacity? So firstly, I hope you're doing it from your fund money roof because startups are risky. There are plenty of angel investing clubs. So Mumbai Angels is one in Mumbai, but there are others. There's Indian Angel Network, there's Angel List, there's a whole bunch of networks that arrange for deal flow. There's one just for investing in women. So they arrange deal flow, and then you can basically co-invest with a bunch of lead investors. How long should the compounding period be? Does it depend on fund outcomes? How should the compounding period be? Ideally, very long. So people love quoting Warren Buffett, right? They say Warren Buffett is the richest or was the richest guy in the world. He has been investing for 60 years. Okay, he is letting it compound, and most of his wealth came after age 60. He's now 90. Okay, so most of his wealth came in the last 30 years, but he started investing when he was 11. So the answer, my friend, is compounding should work for until you reach your goal. And your biggest goal should be retirement, which is basically when you want to stop working. But obviously, you take parts of it and meet your goals along the way. There's no point just saving for retirement and living frugally and you're never enjoying life. That's not the point of life, right? You need to meet your goals along the way. So every time you get close to a goal is when you get that compounding machine stop, convert from growth assets to income assets, which is bonds or cash, and slowly start selling it and get into your goal. Is the bond market safe and good? I assume I have enough cash in hand. I'm a salaried person, not to circulate business later. Is it good to invest in cryptocurrencies? Okay, so this is what I fail to understand. You are saying you're a salaried person. You're asking me, are bonds safe? And then the same question you're asking me, are cryptocurrencies good to invest? So do you see the slight problem here? If you are still learning about bond markets, okay, which is a very basic instrument, bonds issued by the government are safe, but then those issued by corporates, then corporates are investment grade and non-investment grade, and so the list goes, okay? So depending on which, how the company has been rated, and where in the capital structure it's coming from, it's either risky or not risky. But even if it's risky meaning their ability to repay to the bond holders, in the meantime, there's fluctuations that happens which has nothing to do with their ability to pay or not. That's the market deciding whether they agree with the credit rating agency or not. Okay, so that's why in the meantime, bond prices fluctuate. That's how bond prices work, okay? That's how bonds work. But if you don't know that yet and you're still learning, and please take your time to learn, then you should not be asking, even thinking about cryptocurrencies. Cryptocurrencies is something even I don't understand, and I've been in this market for 25 years. I'm still getting my head around it. So I'm simply saying, please only invest in things that you absolutely understand. So take the time. The internet is full of videos and articles that you can read, but don't take my answer, 1 minute answer, and based on that go and invest. Do not do that. So I will not even answer your second question, which is the cryptocurrency part. As someone who's constantly traveling for work from India to Europe to US, what investment advice would you give, considering the plan is to eventually settle in India? If you're traveling for work but you're living in India, then I don't see how that travel for work is even relevant. All I'd say is that when you eventually, wherever you decide to settle, obviously look at what the environment is there, what it costs to live there, but also notice what things you buy, right? If you are buying an Apple phone or a German car or whatever, right? So you are sort of sending money, if you will, to the stock markets of those countries. So just be aware of the basket of things you consume. And maybe also in the Indian market is only 2% of the world market, and it is extremely volatile. Okay, it has a 30% standard deviation, which means that if the market average is about 12-13%, it can go 30 plus 30, so like 60% up, 60% down. That's how volatile it is. So when I said earlier, you should definitely start with Indian ETFs, but please do add international ETFs to them. Yes, you may believe that India is the best place to be long term, and that's great. But if you can't handle volatility along the way, it's a good idea to add more ETFs from different markets in. It's like any masala, right? You have to put multiple things in for it to be palatable. So for your portfolio to be not volatile, for you to not panic, you need to have multiple things in it. And then stop focusing on that one stock or one ETF that went down. look at the overall portfolio and make sure the overall portfolio standard deviation or the volatility is palatable. Okay, that's sort of bouncing around this much rather than like this. Okay, that's what you need to do. Are index funds a good investment, or are they too safe? Yes, for the last time, index funds are good investments. Index funds will give you market return. The safe, when they say it's too safe or too risky, is relative to the index. So the index fund will give you market return. So if the Indian equity market is likely to give you 15% or 10%, the index fund will give you also 10% or 15%. Whatever the market does, the index fund will do as well. That's what an index fund is. An active fund will try to add value 2-3% above that. Okay, try being the operative word. Most of them fail. In them trying to outperform, they will also underperform. And as I said, you will not know whether that's a good thing or not, because you didn't ask for the research note, and even your advisor probably doesn't understand that. So what I'm saying is the index fund is perfectly fine. Make sure, however, that you also have cash and bonds and so on. Okay, I think that is the end of questions, and also we are way past 7 o'clock, so I think we have to close it now. So can I sort of hand back to my host? I don't know how to do that because, like I said, I turned everything on. Ah, there she is. Thank you for being back. Thank you, Ankita. Did I take all the questions?
Yes, we did answer all the questions.
Okay, so I can't hear you because I stupidly turned my speaker off and I don't know how to turn it back on. So I can't hear you. Okay, so I will just hope what you say are nice things about me.
Yes.
And on that note, I will keep quiet.
Thank you so much, Hansi. I know you can't hear me right now, but this video is available. And I'd also like to thank all the people who joined and stayed back. There were a lot of questions. We hope we were able to answer all of those. The idea behind these sessions, which, as I said in the beginning, will be every Saturday, and also the videos will remain on the channel, is to give as many insights on finance, on personal finance, and be here with experts to answer your questions. Next Saturday, we'll have Arvind Rao, who will be talking on taxation. Be there, and the updates will be on the channel. Thank you so much, Hansi, and thank you to everyone for joining. Have a great weekend ahead.